Hello and welcome to the second part on Fibonacci retracement, and this will be mainly focusing within tops and bottoms, not so much how to find them. That will be a later series or a later part, but to signify what the tops and bottoms happen to be. Tops and bottoms are extremely hard to predict, and even when you use Fibonacci to try and find them, that still never guarantees that they're going to be such a case. There's a lot of psychology that moves within it, and I'll be talking a lot about that over many different parts, including today's. But this is mainly finding out what the tops and bottoms happen to be after the fact. And this is going back to 1968 on the silver market, and I have all the tops and bottoms written within this screen. Therefore, it came up to $2.58. How do I know that is the top? Because it is the highest peak within this area. Fairly easy to see along the way. Then you have this low, a higher high. Then 379 would be a higher low, all the way up to $50.50. It really never established a high along the way, at least within this time frame. Another episode or another part of this is using multiple time frames, but for now, we're just going to stick within this chart. A big move from 50 to 10 made a higher low, and overall you would state, well, this is pretty volatile or extremely volatile, and the answer is yes, it is. And then it made a lower high, lower low, lower high, lower low, lower high, lower low, and lower high. And that's been it. Now we made this 397 over 347. That's a higher low, followed by a higher high. The last break low is $8.46, and currently this is at 49.81. Tops and bottoms are known after the fact, and the fact has not been completed yet. 49.81 still may not be the top. For that not to be the case, it pretty much has to keep going higher, and this low would only mean something on the more shorter term time frames. We've already seen massive volatility, so we've already seen before a low go from 375 or so over 50. Therefore, that's reason to state it can go higher, but that's not about this. It's about finding the tops and bottoms, because these are very important when you're working within Fibonacci. We'll now go back to the earlier stages within here, and we'll really zoom in on this. This is a little too zoomy. So we see that we had this high of 258 and this low of $1.27. Therefore, if we take this number and divide it by 127, we get the difference, which is a little over 2. If we take this 2 now and put it to the power of 38.2%, multiply the $1.27, then that would have given us a number roughly around $1.66, which would be pretty much right in here. Therefore, once it managed to get above this line, that meant that it was moving more in towards a neutral state, because whenever you're below this level, that means you would be that of a bearish mark. But what's more important is for a particular move to be a real move. That's from point A to point B, whether it's up or down, it doesn't matter. In this case, going from 258 to $1.27 would be considered going lower. The 61.8% of that move is very critical. Therefore, in this case, we'll bring back that level, the number which is a 2-time difference, put it to the power of 61.8% and multiply it by the low, then that gets you a mark of around $1.97, which would be somewhere in the area of here. Now, oftentimes these levels can give you some sort of resistance level, and within here, that's exactly what happened. It found just a little bit of resistance, and when you see the psychology within this, and you establish this low, which for the most part is either at this line or above it, which is the case in here, and you break above it, it's telling you is looking to be a failure because obviously it's above it, and we see it comes up to this resistance line and is able to break it. So that told us right there that the trend for the downward move is not legit. As far as the move to 676, in another episode I'll be talking about Fibonacci upside, but for now we're going to stick within regular retracement. So you move up to this point and you're starting to retrace lower. What's the Fibonacci that you use would be the 676 high and the $1.27 low. Obviously, it didn't retrace down too much, so we're not even going to calculate what the 38.2% is because it never even went there. But we will calculate what the 61.8% is from 676 and a $1.27. We have 676, we divide the two numbers, and then that gives us a total of 5 1/3. We'll put this to the power of 61.8% and then multiply it again by the low, which gives us a mark of $3.57. We'll find 357, which is somewhere in or around in here, which means that it never even came down to the Fibonacci retracement level. If you're looking to get a position on weakness at this level, I'll talk about that later on, then it just didn't happen. Therefore, you might have to buy this on strength. And that's why I want to talk about both forms of entry. One, buying on weakness, and two, buying on strength. There was no opportunity here to buy this on weakness because it never came down to this line. However, you did make this pattern in here. It went higher. Next thing you know, boom, it broke above it. Now for the Fibonacci that you would be looking for the strength, you see the 676 and the 379. Therefore, for this selling to be a failed move, or for it to be a failed move, it needs to confirm a break above the 61.8% level. So we can take the 676 and divide it by 379. We can put this now to the power of 61.8%, multiply it again by the low, and that will give us a mark which would have been at 542, which would be somewhere in around here. Maybe a hair lower. Therefore, when you were in this situation here within this range, it got up to this significant point, and then it came all the way down. And a lot of markets do this, and then it just does a lot of correcting through time. In order for this selling to be a failure, it has to confirm a break above this line. Well, it got above it. It confirmed it really towards in here. It did not find support where it was supposed to. And when I say supposed to, that means for Fibonacci to be a successful hit at 38.2. The psychology tells you if it doesn't do that, then there's something going on, which would be on a bullish scenario, because bullishly coming back down here was strong. It never even did that, which is a good reason why the market had these spectacular gains in here. And then you had the big move up to $50.50 per ounce. When you're doing Fibonacci from this high, then the levels you can use, one, you can use $1.27. You can also use this 379 low as well. They were both significant areas. If we take the $1.27 low, we'll use the 50-50 high. I don't know for sure what that high was, but it was in or around that area. And we put this to the power of 61.8% and multiply it again by $1.27. Then that gave us a mark of $12.36, somewhere in or around here. Therefore, for this rally to stay on a bullish level, which is this 38.2% down move, it would have needed to stay above this line. If you were looking for a hit at this level, buying on weakness, it hit. You got a great buy, and obviously for the market to go up to 23, there should have been at least some form of profit taking, or at least getting out down towards here at some sort of small profit above the entry point. So the psychology now tells us that when you hit a level like this, you manage to go to the upside and then that's it. You come back down to this level. The levels are giving you an extra chance of not finding support. So if you go to a key level, I generally like to think it's got more of a reflection to be support or resistance where you're looking for the first time it hits it. Now you're back here, it can very easily break it, and that's exactly what happened. Therefore, if we take the same Fibonacci and now look at the 38% of these levels, then this is what we will come up with. We will come up with a level of $5.19. We'll draw a straight line in or around that area, which would be somewhere around here. And once again, it goes below here. You're looking for another buying opportunity. It hits. So now you're in a situation where you've made this high and you've made this low. We know that if you're making a move that it's got to hold the 61.8% moving back in its previous direction for it to be a successful move. If it doesn't, it will become that of a failure. It hit perfectly within here, another buying opportunity if you used it, and then comes up to this level of resistance. In technical analysis within markets, no matter which you're using, whether it's some moving averages, trend lines, whatever, if one breaks and then continues to go lower or higher depending on the direction and comes back, then it now gets changed from that of support to resistance. So the resistance was tested, comes back. This increases the chances it's taken it out, but that didn't happen. It still made this lower high. Now it broke below. When you break below the situation, you're trying to say, okay, wait a second, this move in the 1970s wasn't real, and we're going to show you that it was a failure. Of course, they didn't, because it really stayed below this level. It's almost as if that you're in a situation where you need help. You need 911 help. Maybe you're drowning or something, and well, heaven forbid you actually survived because you were drowning in here, but you got back and now you're doing very well. Overall, this is a failed breakdown. And oftentimes, when you have a failed move doing one thing or the other, you can get a fast move in the opposite direction, which was the case in here. This failed breakdown below this line, then managed to bring the market well high towards the upside. All right, so now as the market's continuing to go higher during the last few years, that is, within this upward trend, you can now state to yourself, okay, this was a successful rally because it held this level and it has moved higher. Now the question is this selling that brought us below here to be a success? Because for that to happen, then that means that the 61.8% from this high and this low needs to hold. We'll do these numbers here, 50.5 divided by the low of 3.47, and we have 14.55. We'll multiply this again by the low. Actually, we won't. We'll just do this. We'll put this to the power first of 0.618. Then we'll multiply this by the low, which is, of course, 347. That means for this selling to be a success, it has to stay and hold below $18.15. And if you use this low, it works out to 19. It really works out to the same difference. And it did manage to come up to this level in here. Now, this was $18. You would have expected at 61.8% hit to come towards this level. If it would not have went down to 846 and kept going higher, the psychology would have told you that there was a grand failed move that occurred and you should be on major alert for big moves. Now that didn't happen. Instead, it retraced. And since it retraced, it came back up to this level. Greater chances you take it out. That's been the case. When you have a big gain and you look for confirmation, confirmation can come in one of two ways. One, it can give you the nice little method where it does something like this, breaking resistance, there's your confirmation. or you can get what is very difficult, and that is it just keeps going higher, and then at some point you have to give in and say, yep, that's a confirmation break above this Fibonacci level, and that's exactly what's happened. Now, as far as the Fibonacci that took us down to 846, if you're at this level, you're coming up towards here, and you're seeing the market sell off, you're like, okay, where are we going towards? Well, we can do the same Fibonacci that we're used to. We can take the 2135 high, divided by the 397 breakout lows, and we'll put this to the power of 61.8%, multiply $3.97, and that gives us a mark of $11.23. Fibonacci was not found at that exact level. In fact, it was an area that it went well below it, or going down to 846. Therefore, the 38.2% would be the 537 again, or the difference from top to bottom. That's what it is, 2135 divided by 397. 38.2% of this, and now we'll multiply 397, which gives us a mark of 755. Therefore, if you would have bought at this Fibonacci level, you would have been right at the bottom, not the bottom, but you still would have managed to be in the money very nicely. And if you would have waited for the $7.50 bottom, well, obviously that did not occur. Therefore, when did we have confirmation break above this significant level in here, which is this level here? Pretty much roughly in around here. Now, the next Fibonacci that you would do is from the 846 low and the 2135 high. So within that one, we got 2135 divided by 846 to the power of 61.8%, and multiply the low again, which would give us a mark at $15 per ounce. That was the level that it needed to hold above to confirm that the selling from here to here was a failure. It was. So now the market's back in an uptrend. So now what Fibonacci do we need to know from here on in? Well, you got the 846 and the 4981. Therefore, if we take a look at this number again, 4981, and divide it by 846, put this to the power of 61.8%, and then multiply it again by the low, then we will get us a figure of $25.30. We're nowhere near there. In fact, that was really the next breakdown if 32 would fail. So far, that hasn't happened. And as long as it holds 25, it really stays bullish within that trend because it's above the first of the two Fibonacci levels. They're not the only Fibonacci marks there is, the 61.8 and the 38.2. For if we take 61.8% and multiply it by itself, we get 38.2. If we do that again, then that's 23.6, which means you have the 76.4%. When things get really out of hand and the movements are really big, instead of looking for 38.2% on the way down, you may rather look for 23.6. And by doing the 23.6 Fibonacci from the 4981 and the 846, then this is what we're going to come up with. It would be a mark of... That's not correct. Let's try it again. 49, I think I did 23.6, and that's 76.4. Alrighty, $33, $32.78. Therefore, if you were waiting for a 23.6% retracement, you would have been waiting for $32.78. Considering the bottom was 32.32, you kind of hit that very well. Now, of course, for this rally to be a failed move, it's really got to break below somewhere down here. That isn't happening. And if you shorten this out, we know for the selling from 49.81 to 32 to be that of a failed move, we take 49.81 divided by the low of 3232 to the power of 0.618 and multiply the new low or the most previous low. A confirmed breakout above 42.22 would make the selling that occurred at the start of May a failure. We still haven't done that yet, but that's what you're looking for. You're looking for that area to show that it's ready to break above that, and then you would most likely receive a test towards the 49.81. But when you're in a bullish trend and you have downward failed moves, you would expect to be making higher highs, and a high that goes from 21 to 49 after its previous one was 795. Well, I'd be looking into triple digits. We've already seen big volatility, and that's the analysis that you are using. Thank you for watching this part 2. Not sure yet what part 3 will be. Most likely I will be doing Fibonacci upside. Take care. Bye-bye.